One of the most overlooked things that makes Warren Buffett one of the greatest investors of all time is his ability to pick the right leaders for the companies that he invests in. In this video, we'll cover exactly what he looks for in his CEOs so that you can use it in your own investing process. If you're new here, this is the fourth step in our 5-step investing process. And it just so happens that this is where I'm at in my own investing. If you haven't seen the last few videos, the company I'm looking very closely at is Lululemon. This video can stand on its own, but if you want to get a full picture of our research process, then I recommend checking out the last 2 videos where I cover the first 3 steps: understanding the business, checking its financial health, and evaluating for economic moats. Some viewers commented on earlier videos if I could show the follow-on steps, but I never got that far because there was something about the company that turned me off. We looked at Boeing, which I became bearish on after evaluating that it was a turnaround situation and not just an overblown setback. We looked at McDonald's, which I couldn't find a good growth story for. And we looked at other companies like Google, Reddit, Disney, and Microsoft. Disney is the only company that I ended up taking a small position in. It's up 37% since I took that position in November. Compared to the S&P 500's return of 13% since then, I'm almost tripling the market. Although I clearly didn't have super high conviction in my analysis, since I only put about $5,000 into it, or about 5% of my public portfolio. And this is what this channel is all about. I'm not just some talking head rattling off useless investing jargon and hot takes. But I'm a real individual investor like you, and I'm looking for my next investment. And I'm sharing my journey and lessons learned along the way. So of course, we'll be using Lululemon as the backdrop in this video. Let's bust into how to find the best CEOs for our company. And to start, who better to ask on how to evaluate management than Mr. Buffett himself?
It's not hard to figure out that, say, Bill Gates or Tom Murphy, or Don Keogh, or people like that are really outstanding managers. And hard to figure out who they're working for. And I could give you some cases on the other end of the spectrum too. It's interesting how often the ones that, in my view, are the poor managers also turn out to be the ones that really don't think that much about the shareholders too. The two often go hand in hand.
We don't get a say or a look into the day-to-day operations of the company. So it's important that the person that we elect to do so, our CEO, treats us as the owners of the business. This starts with the CEO being honest and transparent with us. The number one thing we want to see in every annual report is that the CEO writes a letter, not a press release, describing in detail what is happening at the company, both the negatives and the positives. Warren actually leads by example here. He is incredibly transparent in his letters to shareholders, which he's released every year since 1965. He talks about the business like he's writing a letter to family and friends, and he doesn't hold back when he thinks he makes a mistake or if there's bad news in the business. As another example, take a listen to what this CEO has to say.
Business is doing great. In every one of our businesses, we have market-leading positions. We have a solid core of business, and we're providing consistent, sustainable earnings growth that the street likes it. That's why the stock price has responded the way it has. At the same time, though, we have shown an ability to develop new businesses. We've created a number of new businesses that have been very, very successful, and these new businesses tend to have a high technology content, which the street also likes.
And now contrast it to this.
I like to think that Amazon.com still has the opportunity to be a footnote in the history of e-commerce. We can, as far as we've come, we can, by not focusing obsessively on the customer, we can still lose our whole opportunity to make that little bit of history. But I think it's very useful to keep focused on the fact that we haven't built an important and lasting company yet. We're on our way, and if we don't, it'll be shame on us. Because in the position we're in, we should be able to do that.
Both of these interviews came out around 1999. The first interview is over 30 minutes long. That was just a small clip. I listened to the whole thing, and it's pretty much just him droning on about where the share price is and very topical discussions of the business, saying things like, "We're moving heavier into retail." Okay, I guess I'm too dumb to understand the what, the why, and the how. And that business is, of course, Enron. And that's how they made billions of dollars in their scam, convincing investors like us that we were too dumb to understand their high-minded business. Whereas in that second clip, Bezos really discusses solving a problem and being at the forefront in a huge tidal shift into how retail is conducted. Hindsight is 20/20, but man, I really know who I'd rather put my money with. If it seems like the CEO is only thinking about making money and doesn't have a big ambitious goal in mind, they're probably not the right steward for our capital. Outside of interviews and annual reports, earning calls are a great way to listen to see if the CEO talks to us as owners of the business and to see what their big audacious goal is. Humans are very good at detecting intention. Trust your instincts here. So take a listen and see how the CEO sounds during the call. Does it sound like they know what they're talking about? Does it sound like they're answering Q&As honestly? Do they sound like a salesperson? And does it sound like they're holding some information back from us? Again, trust your instincts here. When I listen to an earnings call, I write these 4 things down to make sure that I'm on guard. This leads us to the second thing that we want to see in addition to the CEOs being honest and transparent. We want them to be driven, also known as that big audacious goal. Driven means they want to change the world in some small and cool way, but a large and cool way is all right too. We want them to have that big audacious goal that we mentioned in mind. Microsoft's Bill Gates and Steve Ballmer wanted to put a PC on every desk. Elon Musk wanted to accelerate man's transition to renewable energy and make electric vehicles affordable for the masses. If a CEO has a big audacious goal in mind, it helps us align to see where the company is going. As Steve Jobs said,
"People who are crazy enough to think they can change the world are the ones who do."
That commercial's a little corny now, but when it came out, other tech companies' commercials looked like this.
Okay, I'm here.
Good. I just wanted to make sure that the new computers are ready to ship.
They're ready.
And they're loaded with the latest operating system?
They're loaded.
And your store guys are ready to teach people all the stuff they can do?
They're all set.
You know, Ted, you're lucky to have a cow for a best friend. Dogs are so overrated.
Those 2 videos came out the same year. You can really tell which one is an aspirational company and which one isn't. Apple would go on to become one of the most valuable companies of all time, and Gateway would continue to face financial turmoil and eventually be acquired for pennies on the dollar to their competitor Acer. It's our belief, and Mr. Buffett's, that vision starts with the CEO. So, how do you know if the CEO has a big audacious goal? Well, if they aren't in your face telling you what the big audacious goal is, it probably means that they don't have one. And in the worst case scenario, they're just worried about making as much money as possible, probably at your expense, just like those Enron losers. Speaking of only caring about making money, this takes us to our next point, CEO compensation. We mentioned up top that we want our CEOs to be shareholder oriented. And one of my favorite Charlie Munger quotes is that show me the incentive and I'll show you the outcome. We want to make sure that our CEOs are incentivized to be shareholder oriented. We have to understand how they are paid, so we make sure that they only get paid if the true owners of the business are also getting paid. There are 4 main ways that executives at companies are paid: salaries, bonuses, stock options, or stock ownership. And we like to see the latter 2. The key thing is we want to make sure that the CEOs don't get rich, even if they ruin the business. For example, in 2022, despite seeing a negative 44% return on the stock, Paramount Global CEO Robert Backish received a $32 million paycheck. This is the exact opposite of what we want to see. Contrast that with Tim Cook, whose base salary was about $3 million, but due to incentives and performance goaling in the company, he received about $83 million in compensation. We can argue if CEOs deserve to get paid that much on a different talk show, but it's good to see that this astronomical comp plan isn't just a given, it's all about performance. This aligns our interests to Tim Cook's interests. All right, let's take a look at Lululemon's CEO Calvin McDonald's pay from this past year. To get our answers, we can go to the annual report and read part 3, but But in part 3, they'll usually tell you to just go check out the recent proxy statements, also called Form 14As, which is exactly what Lulu does. There's a lot here, but in essence, you can see that his payment is incentive-based, with a pretty nice base salary. It's no Warren Buffett 100K a year or Steve Jobs $1 a year, but it's not bad. Speaking of company performance, one of the best indicators on how well management is doing is to look at a metric called return on invested capital, or ROIC. ROIC gives us a sense of how well the company is using capital to increase the profitability of the business. A low ROIC means that the company is pumping money into things but not getting good returns. A high ROIC means that the company is making more money per dollar invested, creating a strong flywheel for investors. For the data nerds who like to know the underlying equations for these metrics, which I highly recommend understanding, return on invested capital is equal to net income minus dividends divided by invested capital, where invested capital is equal to the equity plus debt of the company. To locate a company's net income, you can check out their income statement. For dividends, you can check out their cash flow statement. And for a company's equity and debt, you can check out their balance sheet. And doing all that is a laborious pain in the ass, which is why the platform we're building will be able to list that all in one place. Make sure you sign up for the beta in the description below if that sounds interesting to you. We're building a platform of empowered individual investors to tangibly reduce the wealth gap and restore stakeholder capitalism. For general rules of thumb, a return on invested capital of 10% is good, 15% is great, and 20% is outstanding. And just like in our last video when we discussed evaluating economic moats, we want to check this over the long term. The best way to do this is to look at the compounded return over a 10-year period, a 5-year period, and a 1-year period. If we take a look at Lululemon, their return on invested capital was an outstanding 110% for the 1 year. Their 5-year was a 33%, still really incredible, and their 10-year was 34.6%, compared to a 3.3% ROIC for the retail industry in general. Lululemon is on fire, but predicting that they stay on fire is the tricky part here. One of the best ways to see if a company that has been hot will remain hot is to look at what insiders are doing. And that brings us to the last thing we can look for when evaluating management: insider transactions. Because of SEC reporting requirements, we can see if insiders are buying or selling their stock. And the theory is that insiders, such as executives or directors, are very well informed with the ongoings of the business. And a common misnomer is that insider selling is bad. Insiders will sell for a myriad of reasons, either to diversify or take some chips off the table. Some people use it as a signal, but use your common sense here. If every insider is selling, that's obviously a signal. But the major thing to look for is if insiders are buying on the open market. Insiders buy for only one reason. They think the stock is undervalued and will go up. This is another feature that we're building into Flank. But until we have that feature released, FinViz is a good option for checking to see if people are buying internally. If we take a look at Lululemon, we actually have a really recent stock purchase from one of their directors. Martha Morfitt recently purchased about $1.3 million of Lululemon stock on the open market. This is a huge buy signal for me. This means that she is looking at the non-material information of the company and saying that in addition to the options she receives, she wants to come back to the table. She wants to buy more stock. I may be biased here. Buffett doesn't have much commentary on it, but I personally love when I see insiders buying. All right, that concludes how Buffett-style investors evaluate management. I know there was a lot of information, but it's all very important when it comes to completing the fourth step. We have to understand who is at the wheel of the company and what their intentions and skill level are. If you like this content, please consider liking and subscribing. It would be hugely beneficial for us. We release new videos weekly that go deep on Buffett-style analysis and business. We'll see you next time.